Welcome to TheoTrade. This is Don Kaufman. August 21st, 2020. Doing the weekend update here, seconds after the cash close on this Friday afternoon. Bifurcation and the death of diversification. You know, I've actually talked quite a bit about what I term the death of diversification. But people, that's just the marketplace continues to diverge further and further apart. I mean, you literally have a tale of two different marketplaces, and I am going to describe both of those to you. I mean, when we start talking about like bifurcation, which is obviously a splitting of the marketplace, that goes literally hand in hand with the death of diversification. But this is something that if you are long markets, and I don't want to start pounding the table here at the beginning of a weekend update about being a bear, but if you are long marketplace, okay, right now, you have a 401k, you have an IRA, you're long stock, people, you need to understand what bifurcation and the death of diversification mean. It is imperative, okay, to the future of your portfolio to understand, at the very least, the risks that you're going to face. Let's get started with this weekend's update with just a quick view here of the S&Ps. You know, one of the most effective ways to look at the S&Ps, here's the SPX. I tune into the weekly expected move. So the weekly expected move, this week, we were looking for a little bit more action than we got. You were supposed to have about a $64 expected move. So you're looking for a $64 move up or a $64 move down. And net, what did you get? Nothing. I mean, really, from high to low over here, it was such a minimal range week. We started the range, and I'm just going to hold my mouse on it for a second. Let's just call it 33.70. We end the week roughly 33.97. So this was a really, you know, in comparison to some of the recent trading weeks, a very inside week with a very, very mild grind to the upside. But that's specifically to the SPX. Now, what you're going to see here in a couple of moments is what I start talking about with the bifurcation. Okay, before I get into any of that, before I start talking about the death of diversification, bifurcation, because those are some fairly wild topics, and it's what's in play right now. Like you got to understand that. Before I get any of that, one of the questions I've been getting just almost incessantly, literally 50, 80 emails this week about people understand that I am holding bearish positions. And the assumption is in the bearish positions, you know, you're constantly taking heat and constantly taking heat. Absolutely. Okay. I mean, listen, it's part of the process. And the first thing I want to mention here, when I say that I'm in bearish positions, okay, to hold things like I have a short position in Microsoft. There's no question. I have a short position in Microsoft. Is that comfortable? It's comfortable for me. I'm sized, you know, effectively in there. I carry a short position inside of Facebook. Yeah, after the earnings, ooh, I don't care who you are. That had got to hurt. Okay. I carry short positions in products, okay, like Home Depot. So, and by the way, that's not to say, do I have long positions? Absolutely, unequivocally, yes. I've got long positions all over the place, and this is something that I often detail here at TheoTrade during, you know, the hour and a half that I'm live on a day-to-day basis, and I go through all the different positions. But I want to key into for a second. So I've got the short position in Home Depot. I've got a short position in CSX. Okay, and I can go through some of the usual suspects. Yes, CSX, how exciting, right? Trains, planes, and automobiles. But how am I maintaining some of the short positions, okay, with light of what's actually going on inside of this marketplace, okay? And the answer falls, to begin with, the QQQ. And the hedge that I call saved my bacon. Listen, first and foremost, is a hedge designed to save you, okay, everything? Absolutely not. Okay, as some of these products grind to the upside, and it has been a grind, but let's go ahead and let's actually bring back up Facebook, because actually Facebook is one that is literally, you know, a hop, skip, and a jump away from the all-time high. But actually, as we're grinding higher, what I've gone ahead and done is I have aggregated, and I've talked about this again time and again on TheoTrade, but I've aggregated my net negative delta, and that is how many deltas am I negative. But I didn't do it necessarily to Facebook deltas. I did this in terms of SPY delta. So I figured out exactly how many negative deltas do I have, okay, akin to the spiders. So this is what I call beta weighting. All right, so I go in there and I beta weight. So my beta weighted SPY deltas, let's say, for example, okay, and just my example here is negative, okay, 1,000 SPY deltas when I start to accumulate everything. One of the issues that you got right now, though, is the marketplace is bifurcated. So if I'm heavily weighted towards Facebook and, I've got some Microsoft in there and a couple of other tech stocks, before you know it, the SPY is not moving up at the same rate that is the QQQ. Now, this gets a little bit convoluted. So I know that, and I knew that going in. So what I did is I actually created the hedge in what was actually causing the risk. The Nasdaq has been causing me my risk. Okay, nothing but the Nasdaq. And how did I go about hedging? Hedging, is thought of most of the time when people think of hedging, they're trying to hedge the downside, right? People are scared, the market's running up, the market's running up. And by the way, we're going to talk about that next. We're going to talk about long, okay, and hedging the downside. But most people have to deal with a marketplace running up and all of a sudden, boom, the marketplace falls out of bed and you're like, I didn't have me some puts. And it's hideous. Okay, let me show you exactly how I'm actually hedging to the upside. Okay, I'm using back ratio spreads. Okay, and to use back ratio spreads for a hedge to the upside, those back ratio spreads don't kick in for a little while. But if I actually cruise over here to my account statement, I'm going to go ahead and show you exactly what the hedge was and what I have on and what I've taken off. Okay, the inception of the latest hedge, again, the latest hedge was right here. Okay, and that happened to be on July 30th. So here we are a couple of weeks later. The July 30th hedge was put on, literally put the hedge on for, let's say it's a 39, a 40, a 40. And I by the way, I've got a ton of contracts spread through multiple accounts, multiple brokerage firms now as well. So let's say that net, I put this thing on for a 45-cent credit. Okay, so it's a credit. All right. The key is, and if you're not familiar with beta weighting and your delta, the key is to actually take yourself through analysis and say, if the marketplace moved up, okay, and again, I put this thing on where, okay, right here. This is where I put it on, right? My mouse is literally on it. In fact, I will put X marks the spot. I put it on when the QQQ was trading at 260. Now the QQQ is trading 280. How did I do on it? First of all, I took heat. I took some big heat in some of my shorts, but at the exact same time, okay, if you had enough of the hedge on, it was going to offset risk. Now, again, the hedge was never designed to offset 100% of the risk. The hedge should actually offset anywhere from 1/3, okay, on up just a little bit. So I'm just kind of curbing some of the risk. But here's actually me taking the hedge off. So I took in about a 45-cent credit, and then I went and actually today what I termed whacked the hedge. I took the hedge off, 525, 525, 570, $6 over here. Listen, okay, is that absolutely knocking it out of the park huge? No, but it did exactly what it was supposed to, like to the penny. Okay, because I collected 45 cents, then I kicked in another, $5.50. I made $6. Okay, so I made $6 on a hedge of what? Okay, of a marketplace that at the time, well, it had run up, okay, about $20 inside of the QQQ. So it ran up $20 and I made $6 of the $20 run to the upside. Okay, gold, Jerry, gold. That's exactly what it was designed to do. And I don't mind showing you, okay, because I call this the hedge that saved my bacon. And it did. And I'm still actually hedging, because what I did is I pulled that particular hedge off because it was coming to fruition, the August 28th expiration, 7 days away. And I took the hedge and I actually bumped it out in time. So I kind of reinitiated my hedge out in a little bit of time. By the way, I've got a lot of different positions on, so I don't mind showing you. My hedge now is 35 days out. And I'm doing the exact same thing. I'm actually using back spreads to mitigate my risk. If we continue to the upside, so be it. I mean, listen, I'm not going to stand there and just watch myself get run over. And I want you guys to understand that, because it's something that is an experience level trade, but it's something that just doesn't necessarily resonate with a lot of new traders. And I don't mind showing you today the marketplace ran against me hard. In this account right here, this is where all the duration positions are, people. Okay, I'm down $1,000 today. And I do not mind showing that in any way, shape, or form, because you know what? Right now, I've got some decent size allocation on there, and I'm down $1,000 today on a position. And that is in very large part due to the fact that I hedge. Okay, I know when to pull the ripcord and to say, all right, I need to mitigate my risk over here. All right, next, we got to come to long is dangerous. Long is dangerous, and hedging is tough. with the recent rise inside of the Nasdaq, maybe I should put it in this terms. Here, there's a 20-year monthly chart. That doesn't do it justice, right? You missed some of the best the best parts of the crash in here. Wait, let's come over to a maximum chart when they went right from the inception of the Qs. But you could look at the S&Ps, you could look at the Qs, whatever does it for you. Okay, the QQQ has gone absolutely unequivocally parabolic. Okay, and this is where people are like, oh, it's the Fed, it's this, it's that. Okay, it doesn't matter what you think. It just, seriously, it just doesn't matter what you think about, is it the Fed, is it this, is it that? Okay, you have to be worried, obviously, about the substantial move to the upside. The problem, though, isn't necessarily just the move to the upside. Okay, when we start to look at this and look at it objectively, it's next to impossible to actually hedge the positions right now. So even though the marketplace is running up, and the marketplace is running up, you have a VIX that's sitting, what, in the 20 handle. So the VIX is actually north of the 20 handle. But more appropriately, some people go, don't worry, I'll hedge my risk to the downside. Have you gone out here? Let's just go out 28 days and open up all the strikes, and you pull up implied volatility. And what I want you to see when you look up at implied volatility is, and I've got gamma irons and so forth on out here, but when you start looking at the implied volatility, look how the implied volatility is totally jacked up. I mean, it's ridiculous. Okay, so they're already pricing in tail risk. Okay, even tail risk has risk because the implied volatility is so high of that of those out of the money options. Like again, they're pricing in tail risk. So to hedge a portfolio right now, what I'm concerned about for people, and that's again, this is not me getting bearish. Okay, I'm genuinely concerned that you may have, okay, a 401k. You may have an IRA. And, you know, I was in the brokerage business from about 2001 to 2015. You know, in all the years in the brokerage business, you know, what do you remember the most? I'll tell you what I remember the most in all the years in the brokerage business, okay? Probably 2008, 2009, when people lost pretty much everything. Especially some people were margined, not in their 401k obviously, but some people were margined, literally wiping out accounts. There's one day in particular that I remember, okay, that the net lick of all clientele, and this is back in the days of thinkorswim, and I don't often tell stories like this, but back in the days of thinkorswim, and this is thinkorswim, but before thinkorswim was acquired by TD Ameritrade, there was a day that I remember that the net lick of clients was down almost $400 million. Yeah, that doesn't sound like 400 million. How much was there? Okay, let's just say it was about a 10% decline in one day, okay, of the total net liquidating value of the whole firm. The scariest thing I've ever seen. And I'm telling you, in a position like this, when we're watching the market run up day in and day out, okay, this isn't about me being bullish or bearish. If you haven't noticed lately, the types of trades that I'm placing, I'm all about like gamma iron, get neutral. I'm actually using back spreads to the upside. Okay, I'm taking huge shots to the downside using risk twist spreads, back spreads to the upside, gamma iron, which is actually net neutral. Yes, I have bearish positions on because the bearish positions to me, it's where the risk reward is. You know, that's like when you look at the upside of Microsoft versus the downside risk, I think the downside risk is going to be phenomenal and I want to be short. But I'm not here to argue that. Okay, I am here to argue that you have to understand, okay, that the amount of risk that you're taking on in your 401k and IRA. People say, how am I going to hedge? What am I going to do? We can help with that, but at the same time, maybe just lighten the load a little bit. If you took off 30% of some of your positions, it wouldn't be the end of the world. And I don't want to preach to anybody that doesn't understand these concepts, but you got to understand right now how extraordinary of a marketplace this is. Okay, and forget about, I'm not including any of the discussion here, like we whatever with the coronavirus. Doesn't matter what you think. It just doesn't matter. Okay, all that matters at this point is that we have a run to the upside, and that run is causing a wild bifurcation. And I'm actually going to show you a little bit about that bifurcation right here, right now. If you look at the expected moves, let's actually get to the expected moves. So I'm actually going to use our auto expected move script. Okay, the SPX did, roughly speaking, nothing, right? The S&Ps did nothing. But when you start to look, though, individually, let's look at the QQQ. The QQQ cracked to the upside of its expected move, which means this week, the QQQ not only outperformed, the QQQ, okay, outperformed even what the option market intended it to do, which is a sign of great inefficiency in a marketplace. Literally, the marketplace is screaming, I'm inefficient. I'm not even doing a good job of handicapping risk. That's what happens when you crack outside the expected move. And okay, this has been going on week in and week out, cracks of the expected move. At the exact same time, were you aware that the IWM actually came down and almost touched the bottom of the expected move? So I just wanted you to compare the QQQ, the SPY, the IWM, but then you start to look at the XLF, okay? Yeah, the sector that's been beaten and bludgeoned already, which happens to be none other than the financials. Look at them on a year-to-date percentage, okay? They're still down almost 22%, okay? And the QQQ is up 30%. It's just shocking right now. That's what I'm talking about with the bifurcation. It's a tale of two totally different marketplaces. Then you start looking at the energy sector. I mean, I think you could probably make good, reason for the energy sector being down. Nobody's going anywhere. No planes are flying. I got it, But at the same time, when you start to see sectors, not just they're falling apart, people, okay? And what do you have left? You got what? Tech stocks left. And you understand that this bifurcation, what it's doing is from a sector to sector basis. We often look at advanced decline line here. You have a marketplace. You have a marketplace with a 50-50 advanced decline line today. That's just up. Except, of course, for the Russell, which is down and down big. But the advanced decline line today is up, okay? Or I should say flat. But then you start to look at the sectors, okay? And if you haven't looked at actual sectors, all right, the sectors themselves, there's only really one or two sectors that actually matter anymore. Because what's going on in this again, huge bifurcation that's going on, okay, what's going on is stocks like Apple, because it's a $2 trillion stock, is now umpteen times more important than JP Morgan. JP Morgan can't even be, you can't even have a JP Morgan, okay, conversation and have Apple in the same paragraph because JP Morgan's not worth anything anymore in comparison to it. As crazy as that may sound, but it's the reality. When you start looking at market cap, which Apple now is $2.1 trillion market cap, and then just to pull up JP Morgan, okay? JP Morgan right now is about a $300 billion market cap, okay? Then you start bringing up stuff like Tesla. So we started looking at Tesla. Apologize there. Tesla! And Tesla is now worth more than Walmart. Okay, it is worth more than Walmart as of today. So it's official, people. You got Tesla now worth more than Walmart. But the impact of this, okay, is not being felt right now. Other than the fact that it's dragging the marketplace up, what's the bigger impact? The impact is, okay, it only takes one or two stocks then getting rocked to absolutely crush the S&Ps or the Nasdaq for that matter. That's the risk you actually take. When you start to talk about diversification is dead, bring up the S&P 100. When I do bring up the S&P 100, this is what I'm referencing. This is the Nasdaq 100. When I drag my mouse on the screen, what I want you to see, okay, there are 11 companies, okay, 11 companies that are now 58.6%. Why do I pick 11 and not 10? Because Google has counted twice. Google has counted twice inside, okay, of that top 10. But so that's why I pull up the top 11. Basically now 60%. You do realize that just a few weeks ago we were laughing about the fact that it was 45%. Now it's actually 60%. And that's why, again, a very large part, if you think you're diversified, you're already dead. You just don't know it yet. And that's when, well, but Don, I'm in the S&P 500. Yeah, the S&P 500 is completely weighted to the exact same stocks. And it's again, it's not just alarming, it's everything. Okay, when you start to look at S&P 500, analysis over here, all right, we start looking at the S&P 500 analysis. These are top performers in the S&Ps. Okay, so S&P 500 analysis, and you start to dig into this. Okay, guess what? In that same couple of stocks, there's the same 11 stocks now that are worth 30% of the S&P 500. And it just gets crazier ultimately from there. So I didn't intend to bring that up, but again, I'm on a roll over here and I'm going to go with it because you need to understand that these spiders, they used to be a very safe, place to be. It would take the entire S&P 500 to pull them down. Now, theoretically, you could have couple of tech stocks take the S&P 500 and completely destroy it, 20-30% in a matter of days because there's going to be a lack of liquidity. You know how hard it is when you have a handful of stocks, okay, that have so much value. Okay, when you have a handful of stocks that are this big, if they start to move for the door, there's not going to be the liquidity. All right, not only an Apple, but there's not the liquidity to actually support things like the spiders if we start to go down. The other thing that you have to recognize is the correlation coefficients are incredibly high, even for stuff like EEM. So people think, well, instead of being, in the Nasdaq 100 to the S&Ps, maybe I'll go to the emerging markets. Maybe I'll go to low beta stocks. Low beta is not low risk anymore. By the way, the EEM, which is the emerging markets, has a beta of 0.92. 0.92. All right, right there is 0.92. And I even did a little bit more homework on this front. I've been looking at other positions in stuff like HYG. Let's go ahead and bring up HYG, which is actually junk. Okay, junk is supposed to have a beta of 0.42, except when I looked at the correlation, okay, of HYG, and I was actually doing this the other day on one of the videos, one of the evening videos is doing this, compare with custom symbol and just type in SPY. Okay. Apparently I can't type over here, so I apologize for that. Snap that back for a second. Come over here, add study. Let's go compare with SPY. Let's get the S in there this time. Compare with the spiders, they almost are now looking like a 1-for-1. The point that I'm making is, okay, when you think you were diversified from a couple of years ago, and that's exactly what I'm actually displaying in this particular chart, there used to be a differential, okay, between things like spiders, this is spiders, and of course junk bonds. All of a sudden, okay, they're almost moving in perfect relative tandem. There's again, and I bring up the junk bonds, and I'll tell you why I bring up the junk bonds. The junk bonds, I've actually been trading those. By the way, I'm actually going to pop up here. This is Tastyworks. So after everything that occurred this past week, everything that occurred this past week in thinkorswim, you guys got to remember, I spent 15 years of my life working to help build some of the thinkorswim trading application. Obviously, I spent 15 years at both thinkorswim and TD Ameritrade. I am not only beginning to, but I am shifting a huge amount of capital now over to Tastyworks. And here at TheoTrade, we are providing a wonderful incentive to do so. So by all means, we have a link directly on the TheoTrade site. We'll put a link below this video for you to actually open up a Tastyworks account. We're incentivizing people to do so. I mean, my take is simply this. Obviously, TD Ameritrade is going to be no more in a few weeks. In a few weeks, that's going to be now Charles Schwab. And I didn't like the issues, obviously, that thinkorswim had this week. And if you think this is going to be an issue, okay, well, just wait. Charles Schwab has not had a great track record with mergers and acquisitions. So here at Tastyworks, one of the things I love, I actually am displaying. Okay, I like the option chain. That's what I'm getting to here on Tastyworks. I like the option chain. I don't charting and so forth. I'm not a big chart guy, but in the option chain, it actually displays. I'm short 1, long 3, short 1. This is actually an HYG risk twist spread, and that risk twist spread, okay, is designed to take advantage, if you will, of a huge move, if you would, to the downside. So I'll still do a lot of analysis here on thinkorswim, but I'm trading away, people. I'm starting to trade elsewhere right now. So I also wanted to reiterate, as I said, low beta doesn't constitute low risk. When you think of low beta, what do you think of? I think of like utilities. To me, I'm serious. I think of utilities low beta, 0.24. Okay, but did this have low beta? Hell no. Okay, I mean the risk inside of even low beta right now, there's no diversification. That's what people don't get. Where are you going to go? You're going to go to the bond market? Because if the bond market starts to get nuts, you know that the Fed is going to step back in and they're going to do yield curve control. Even though their statement this week said, we're not going to touch yield curve control. Of course, they're going to come in with yield curve control. All right? Got to understand, diversification completely died, and this bifurcation is causing it. And again, it's the death of diversification because of bifurcation. That's the huge point that I wanted to make this week, that no matter what you think, like, are there safe havens inside of the marketplace? I'm going to go to gold. Okay. Yeah, well, you're going to go to gold as long as it performs, but it may have already performed. Okay, and this, we could talk about the metals to pretty much we're blue in the face over here, but even the metals have just gotten downright sketchy in this marketplace. If there's going to be a contraction in the marketplace, we very well could see an asset flush that has risk, okay, proliferating everywhere out there. So last thing I wanted to take a quick look at, the VVIX. This is the volatility index still refuses to crack really under the 110. We are still in what we term the VAMA zone. Okay, up here is the VAMA zone. What that ultimately means is that window is wide open. Anytime that the VVIX is north of 110, you can and should expect relatively anything. Well, the anything that we're getting right now is a bifurcation of the marketplace. Okay, the reason I'm just displaying this is you got to understand. Volatility, the volatility index is this high. It doesn't matter whether the market's rallied. You just do not get off your game. The last thing I wanted to mention on this particular front was the SPX and its expected move for the week. So again, we had about a $64 expected move from this last week of trade. What are we expecting moving forward? Okay, so in the next week of trade, we're expecting precisely 7 days out. Expected move, people, drops substantially. Okay. Again, I look at this as wildly advantageous. You got to recognize, I've been buying options premium in gamma irons, and it's been working. Last week, we closed a ton of trades profitably. This week, just getting some more gamma irons on. We like it right now when we see volatility crushed down, because the more volatility gets crushed, the more opportunity we see in the future, because it's only a matter of time before the SPX starts smashing through the edges of those expected moves. All right, that's it for this weekend's update. Again, as I said, bifurcation really leading to the death of diversification. Have a wonderful weekend, everybody. Bye-bye.